Hi, I'm Lorna Illingsworth, an independent financial advisor for Protection and Investment Southampton, and today we're going to talk about tax relief on pensions. Tax relief is essentially the government repaying some of the tax you would have paid if you'd kept that money as salary. This is called tax relief and means your savings are boosted by 20% or more depending on your rate of income tax. Tax relief boosts your savings without you needing to do much. If you're on a net pay scheme, contributions come out of your salary before tax. That means you automatically receive all the tax relief you're due and there's nothing you need to do. If you're on a relief at source scheme, your contributions come from your tax salary. Your provider then claims 20% tax relief back from HMRC on your behalf. If you pay tax at higher rates, you'll need to claim the extra relief yourself. That could mean contacting HMRC directly or completing a tax return. There's a limit to the amount you can contribute to a pension and receive tax relief. In the current tax year 2025-2026, that allowance is £60,000 or 100% of your annual salary, whichever is lower. If you have no income, you can still contribute up to £3,600 and receive tax relief each year. And tax relief only applies up to age 75. Usually you won't need to claim it at all, as your pension provider or employer will automatically apply the appropriate tax relief on your behalf. However, if you pay income tax at a higher rate than the basic 20%, or if you're still paying into an old retirement annuity contract, you will likely need to claim the tax relief yourself. You can usually backdate a tax relief claim for the previous 3 tax years, so make sure you've claimed the full amount you're entitled to. If you run your own limited company, you can choose whether to pay into your pension as employer contributions or employee contributions from the salary. If you choose to make employer contributions, you can usually deduct them as a business expense, meaning your company reduces their corporation tax. However, contributions must pass the wholly and exclusively for the purposes of the business test. So they must be reasonable for your company's size and profitability, and excess contributions that don't match your business circumstances could be challenged by HMRC. Salary sacrifice is an arrangement where you give up part of your gross salary in exchange for an equivalent employer pension contribution. Both you and your employer benefit because you pay less national insurance, and your employer pays less employer national insurance contributions too. However, reducing your salary can affect borrowing capacity, which is especially important if you're looking to get a mortgage or a loan. And just like with other contributions, once the money is in your pension pot, it's intended for your retirement. You cannot access it until you're at least 55, rising to 57 from 2028. So make sure you have enough accessible savings before you commit to salary sacrifice. If you'd like to discuss tax relief on your pensions, please call us on 02380 668 407 or visit our website.